Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and with me, as always, is Lana Chen. Today, we're breaking down the world's largest off-price retailer, TJX Companies, ticker TJX. Episode 111, let's get into it.
Hudson, this is a company that has essentially turned bargain hunting into a $178 billion empire. They just posted 5% comp sales growth in fiscal 2026, while traditional retailers are scrambling to clear shelves. The off-price model is winning, and TJX is the reason why.
And here's the wild part. They're actually benefiting from the tariff chaos that's crushing everyone else. When department stores panic and dump inventory, TJX's buyers are the first ones on the phone. It's like they built a business model designed to thrive in uncertainty. Let's unpack how they do it. All right, let's set the stage. TJX Companies traces its roots back to 1956, though the modern company really took shape in 1977 when the first TJ Maxx opened in Auburn, Massachusetts. Today they operate over 5,000 stores across 9 countries, from their headquarters in Framingham, Massachusetts.
And the scale here is remarkable. TJX runs 5 distinct retail banners. In the U.S., you've got TJ Maxx and Marshalls under the Marmaxx segment, which is the bread and butter. Then Home Goods and HomeSense for home furnishings. In Canada, they operate Winners, Marshalls, and HomeSense. Internationally, TK Maxx covers the UK, Ireland, Germany, Poland, Austria, the Netherlands, and Australia. And Sierra handles outdoor and active lifestyle.
What makes this business tick is the off-price model. They buy branded merchandise from over 21,000 vendors at steep discounts, 20 to 60% below regular retail, and pass most of those savings on to customers. It's a treasure hunt experience. You never know what you'll find, and that keeps people coming back.
The sector classification is consumer cyclical, specifically apparel retail, but I'd argue TJX has proven more resilient than that label suggests. With roughly 340,000 employees worldwide and $60 billion in annual revenue, this is a company that has demonstrated its ability to grow through almost any economic environment.
The man running the show is Ernie Herrmann, and his story is about as TJX as it gets. He didn't parachute in from a consulting firm or a rival chain. Herrmann joined TJX in 1989 straight out of Boston College with a merchandising role, and he's been with the company for 37 years.
That kind of institutional knowledge is incredibly rare in retail CEO roles. Herrmann rose through the ranks from merchandising to COO of the Marmaxx division in 2004, then president of Marmaxx, then group president overseeing multiple divisions. He became president of TJX in 2011 and CEO in January 2016.
So this is a guy who understands the buying floor, the vendor relationships, and the store economics from the ground up. That matters in off-price more than almost any other retail format.
Exactly. Under his leadership, TJX revenue has nearly doubled. They've surpassed 5,000 stores globally, expanded Home Goods to over 1,000 locations, and grown TK Maxx across Europe. Wall Street respects his no-frills, execution-focused approach. His entire incentive compensation is tied to objective financial metrics. No fluff, just results. Let's get into the numbers because TJX just turned in a very strong fiscal 2026. Full-year revenue hit $60.4 billion, up 7% year over year. Comparable sales grew 5%, and diluted earnings per share came in at $4.87, up 14%.
When you look at the quarterly progression, the momentum is clear. Q1 started at $13.1 billion with 3% comps. Q2 accelerated to $14.4 billion with 4% comps, and Q3 and Q4 both delivered 5% comps on revenues of $15.1 and $17.7 billion respectively.
That Q4 number is the seasonal peak, think holiday shopping, and the $17.7 billion was well above expectations. The company beat earnings estimates in all 4 quarters of fiscal 2026. Q2 was the standout, with EPS of $1.10 versus the 96-cent estimate, a 15% beat.
Let's talk profitability. How do the margins look?
Gross margin expanded 40 basis points to 31% for the full year. Operating margin reached 12.1%, up 60 basis points year over year. These might not sound like massive numbers, but in retail, where you're working with thin margins at enormous scale, Every 10 basis points matters. On $60 billion in revenue, that margin expansion translates to hundreds of millions in incremental profit.
And net margin?
Net margin came in at about 8.7%, producing $5.5 billion in net income. That's a very healthy profitability profile for a retailer of this size. For context, Walmart's net margin is around 3%, and even Ross Stores sits at about 9.4%.
The balance sheet tells a nice story too, right?
It's one of the cleanest in retail. TJX ended fiscal 2026 with $6.2 billion in cash against only $2.9 billion in debt, excluding operating leases. That's a net cash position of over $3 billion. Total assets are $35.8 billion against $10.2 billion in shareholder equity.
A retailer with net cash on the balance sheet, that's not something you see every day.
Operating cash flow for the year was $6.9 billion. Capital expenditures were roughly $1.9 billion, giving you free cash flow around $5 billion. That strong cash generation supports the 13% dividend increase they just announced and a $2.5 to $2.75 billion share buyback authorization for fiscal 2027.
So they're returning serious capital to shareholders while still investing in growth.
Overall, TJX's financial health is strong. They have a net cash balance sheet, growing free cash flow, expanding margins, and accelerating revenue, all while returning significant capital to shareholders. It's a textbook example of a well-run retailer firing on all cylinders. The street loves this stock. The consensus rating is strong buy, with 16 buy ratings and just one hold, 0 sells. The average price target is around $176, which implies roughly 7% upside from the current price of $164.45.
Who are the most bullish analysts?
BTIG has the highest target at $185 with a buy rating. Deutsche Bank is right behind at $184. JP Morgan maintains overweight with a $173 target, and Telsey Advisory just boosted their target to $175 after the Q4 results. The low end of the range is around $155 and the high is $195.
What about the earnings track record? That seems to matter a lot for a retail company.
TJX has beaten earnings estimates in all 4 quarters of fiscal 2026. The beats ranged from about 4% in Q4 to a 14.5% beat in Q2. That consistency builds credibility with the street and is a big part of why the stock commands a premium multiple.
And what's the forward look?
This is where it gets interesting. Management guided fiscal 2027 EPS to $4.93 to $5.02, which was actually below the consensus estimate of $5.17 at the time. Q1 guidance of 97 cents to 99 cents was well below the $1.24 consensus. That cautious guidance has been management's playbook: set the bar conservatively, then beat it.
All right, let's do the bull case. And honestly, there's a lot to like here. First, TJX has one of the most durable competitive advantages in all of retail. Their buying network, 1,300 buyers working with 21,000 vendors, creates a sourcing moat that took decades to build and is essentially impossible to replicate at scale.
I'll give you that. The vendor relationships are real. But here's the bear case. The stock is trading at 33 times trailing earnings, near its all-time high of $165.82. That's a premium valuation that prices in a lot of continued execution, and there's limited margin of safety if anything goes wrong.
Fair, but the growth runway is substantial. TK Maxx International has 814 stores with a target of 1,225. HomeGoods just crossed 1,000 stores and is targeting 1,800. That's years of visible store-driven growth before they even need to find new markets.
The counter to that is the FY 2027 guidance. Comp sales growth is expected to decelerate from 5% to 2 to 3%. If consumer spending weakens further, and there are real macro headwinds out there, comps could go flat or negative, which would be a significant derating catalyst for a stock at this multiple.
True, but here's the tariff angle. TJX is actually a net beneficiary of tariffs and trade disruption. When traditional retailers get stuck with inventory, they can't sell at full price. It flows into the off-price channel. Herman himself has said merchandise availability is fantastic right now.
That's a cyclical tailwind, not a permanent one. If tariff policy reverses or traditional retail adapts, the merchandise pipeline could tighten, and e-commerce remains a blind spot. Less than 2% of sales are online. In a world where Amazon is increasingly competing on price, the lack of a meaningful digital presence is a real vulnerability.
How does TJX stack up against its off-price peers?
TJX is the clear category leader at $178.5 billion in market cap. Ross Stores comes in at $71 billion, Burlington at $21 billion, and Dollar Tree at $24 billion. So TJX is 2.5 times larger than its nearest off-price competitor.
What about on fundamentals?
On profitability, TJX's 31% gross margin is competitive with Ross at 27.7%, but well below Burlington's 43.7%. However, Burlington's higher gross margin doesn't flow through to the bottom line. Their net margin is only 5% versus TJX's 8.7% and Ross's 9.4%. TJX's operating efficiency at scale is the differentiator.
And on valuation?
TJX trades at 2.83 times sales, roughly in line with Ross at 2.92. Burlington is cheaper at 1.8 times sales, but with lower profitability and more execution risk. Dollar Tree at 1.42 times is the cheapest, but it's a fundamentally different business model. Among true off-price peers, TJX commands its premium through superior scale, consistency, and international optionality. The options market on TJX shows mixed sentiment right now. The put-call ratio is hovering around 1.2, which leans slightly bearish, with implied volatility sitting around the 45th percentile, so not particularly elevated.
What's driving the activity?
There was a notable spike in put volume recently, with over 12,000 contracts in a single session, about 10 times the typical daily average. The overall sentiment breakdown shows roughly 36% bullish versus 54% bearish positioning. That said, this likely reflects hedging and profit-taking after a strong run rather than fundamental bearishness. The stock is trading within $1 of its all-time high, so it's natural for some protective positioning. As always, options data is one signal among many and doesn't predict where the stock is heading.
What are the insiders doing?
Over the past 6 months, there have been 4 insider sales and 0 purchases. CEO Ernie Herrmann sold about 54,000 shares for roughly $8.2 million across multiple transactions. Senior EVP Benjamin Peter sold about 4,000 shares for $500,000, and Director Alan Bennett sold 8,000 shares for about $1 million.
All sales and no buys, should that concern investors?
Not necessarily. These all appear to be routine dispositions tied to equity compensation vesting. When a stock is trading near all-time highs, it's perfectly normal for executives to diversify. There's no unusual clustering or timing that would suggest insider concern. The pattern is consistent with a management team that owns significant equity and is managing their portfolios prudently.
What should investors be watching most closely?
I'd highlight 3 things. First, the comp sales trajectory in fiscal 2027. Management guided 2 to 3%, down from 5%. If that decelerates further, it would challenge the growth narrative that supports the premium valuation.
Number 2.
The e-commerce gap. At less than 2% of sales, TJX is dramatically behind the curve on digital. The treasure hunt model is hard to replicate online, but consumer shopping habits are shifting, and competitors are investing heavily. How TJX evolves its digital strategy over the next 12 to 18 months will be a key differentiator.
And the third?
Tariff policy. Right now, tariffs are a net positive because they're creating merchandise availability. But if tariffs escalate further, particularly on goods sourced from China, India, and Southeast Asia, the cost impact could start outweighing the availability benefit. Watch the Q1 FY2027 earnings call in late May for management's updated commentary on tariff impacts and inventory flow.
All right, let's bring it all together. TJX is the dominant player in off-price retail, running a business model that has proven resilient across economic cycles. They just delivered their strongest fiscal year with $60 billion in revenue, expanding margins, and a pristine balance sheet.
The key metric to watch is comparable store sales growth. As long as TJX can sustain mid-single-digit comps or even low single digits with continued margin expansion, the bull thesis remains intact. A sustained move below 2% comps would be the signal that the growth story is maturing and the premium multiple may be at risk.
I want to close with this from Ernie Herman. He said, "We believe we have one of the most flexible business models in retail. This allows us to buy close to need and adjust our selections as macro trends and consumer preferences change."
That really encapsulates the TJX thesis in a nutshell: flexibility as a competitive weapon. In an environment where rigidity is getting punished, TJX's ability to pivot in real time is what separates them from the pack.
That's going to do it for episode 111 of Charged Alpha, our deep dive into TJX Companies. Whether you're impressed by the off-price moat or cautious about the premium valuation, this is a company that demands a spot on your watch list. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities, no sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.